Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. Today I want to go over the inflation data released today by Statistics Canada. A lot of people and a lot of commentators were expecting us to follow the lead of the U.S. in our inflation data, and the Bank of Canada had actually released a few reports cautioning us that inflation was expected to rise and they were going to let the economy run hot. So today I want to go over the data that was released this morning, which I think we're in for a few surprises, and we'll go over what that means for interest rates and our mortgage rates going into the future. Last month, the inflation data for May came out, and Canada was at 3.6%. This was relatively high inflation for Canada, as the Bank of Canada's mandate is to keep us on that right around that 2% range. So when the reports came out that we were at 3.6%, there was quite a few articles out there saying that this is just transitory, expected high inflation for a little bit for the foreseeable future, but not to be cautioned because this is all transitory inflation and it's reflective of how low prices were last year. So there was quite a bit of excitement to wait for the June inflation numbers to come out, as we were expected to run quite hot. The U.S. inflation numbers were also released recently, and they came in at 5.4%. So it was widely expected that Canada was going to follow suit, and there were warning signs bracing everybody to see higher inflation numbers, especially as we're opening up. And a lot of the country is now out of lockdown, and things are starting to go back to at least semi-normal. Come this morning, though, Stats Canada releases a report, and we only had 3.1% inflation, which is strange to say only had 3.1%, but it was much, much lower than expected. So what's that mean for the economy? Well, basically it means that we're not running as hot as we thought we were going to. We're not moving back to as normal times as quickly as everybody thought with the reopening from COVID. So with us only growing at 3.1%, that's much lower than the expectations of the central bank and a lot of commentators out there, as we had thought we'd follow closely in line to that of the United States, and they're running a little over 5%. So what's that mean for the overall economy? Well, it means that we're not expanding as fast as we would have liked. The Bank of Canada wanted to see us following closely behind the U.S. in how fast their economic growth is going, which, as we mentioned, was around 5.4%. So while 3% is still higher than usual, than normal times, than the Bank of Canada's mandate at 2%, it's still far lower than we would have expected, given that our economy has largely opened up, and in large part there's a lot of people back to work. So this definitely points to our economy might not be as strong as we thought it would. So what's that mean for mortgage rates and interest rates in general? Well, the Bank of Canada signaled that it does not plan on raising rates to lower our inflation, to cool down the economy well into 2022. And like I said, it was bracing us to look for 3, 4, 5% inflation without it raising rates, when it would usually raise rates anything over 2%. So with inflation so low, it's highly unlikely that we're going to see the central bank raise rates anytime soon. Earlier this month, they tapered even more, meaning they stopped providing so much stimulus to the economy, thinking that our inflation was going to be much higher than it actually turned out to be. So we could see the central bank, the Bank of Canada, step back in to try to get some more money out there, or we could see a wait-and-see approach from the bank, just to see what July's numbers end up being, now that we're almost fully reopened. So basically, everyone's been concerned about the rate of inflation and whether or not we were entering into a period of hyperinflation, which was prominent throughout the news articles for the past month, as everyone was expecting us to hit that 4 or 5% that the U.S. did. And I mean, obviously, our inflation rate's lower than it was the previous month, which is really not what you would expect as reopening efforts grow further and further and more people are back to work. You would really expect those numbers to go in the opposite direction. So that's definitely a surprise today out of StatsCan, and I'm sure we'll have a lot of articles out on why the inflation numbers were so low comparatively, and what to expect for the future out of the Bank of Canada. My expectations are that the bank's going to take a wait and see approach. They're going to wait and see what happens with the July numbers now that everybody's basically fully reopened in Canada, and they're going to wait and see what happens with the July numbers. Just because they don't want to, I don't think that they're going to want to restart or start going back to the quantitative easing in the same manner in which they were before. So they're going to want to keep with how far back that they've taken themselves out of the economy. And just see if we can maybe, if we do start growing at a faster pace again. As far as mortgage rates go, with the inflation so low compared to what we thought it was going to be, I wouldn't expect the Bank of Canada to raise rates anytime soon. And more importantly, for your purposes, for mortgage purposes, the banks probably aren't going to expect the Bank of Canada to raise rates at any time soon either. So if the banks don't expect the Bank of Canada to raise interest rates, then it's highly unlikely that the banks are going to raise interest rates. So for now at least, this inflation data seems to support the idea that we're going to be in a period of low interest rates for the foreseeable future, at least until we see that inflation data go a little bit higher and we see a little bit more economic growth from the recovery. Once we see that hit that 4 or 5%, maybe then the bank will consider raising rates, but for now, we can look for a period of lower interest rates. I do want to do I am in the process working on another video based on a Bank of Canada report released this week, showing that how much they do plan on letting the economy run hot, and that to a certain extent we're actually in a period of negative interest rates. So that'll be coming out soon. If you like this video and you do want to get released and you do want to get notified when more videos are released, please do click like and subscribe. And thanks for watching.